Thank you for tuning in to leaddeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at leaddeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome to the Deep Dive. We're diving into the sometimes confusing, often overlooked world of after-tax cash flow in real estate.
That's right. It may not be the most glamorous topic, but trust me.
It's kind of a big deal.
It really is. It's the foundation of smart decision-making in real estate. You might have heard that saying, it's not what you make, it's what you keep.
I have heard that.
Well, in real estate, that's exactly what after-tax cash flow is. It's what you get to keep.
Okay, so no spreadsheets then.
Well, some numbers might come up, but we'll keep it practical.
Sounds good.
Our goal is to understand the core concepts, see how after-tax cash flow helps us make better investment decisions.
So after-tax cash flow, what does it really mean?
Imagine you buy a rental property, right?
Yeah.
Every month you're collecting rent.
Sounds good so far.
But there's more to the story. You also have expenses. Mortgage payments, property taxes, maintenance, and taxes on that rental income.
Yeah, it's like running a business.
Exactly. And after-tax cash flow, that's your profit. What's left over after you've taken care of all those expenses, including taxes?
So it's not just about how much rent I'm getting, it's about what's left after, well, everyone gets their share.
You got it. And understanding this number, it's crucial. It tells you how profitable your investment really is.
Okay, I'm seeing why this matters. How do we calculate this after-tax cash flow?
Well, our source material actually breaks it down into 8 key steps.
8 steps. All right, lay it on me.
Each one builds upon the previous one. The first step is defining your cash flows.
Defining cash flows. That sounds pretty basic.
It is, but there are actually different ways to look at cash flow in real estate.
Different ways? Like what?
You can look at it from the perspective of the property itself before any taxes are taken into account. That's your before-tax cash flow.
Okay, so that's the overall picture of what the property is making and spending.
Exactly. But as an individual investor, you're also interested in what you personally keep after your own taxes are factored in. That's your after-tax cash flow.
So it's kind of like zooming in from the big picture to my own financial situation.
Exactly. And then there's another layer, what our source calls equity cash flow. This is the cash flow generated from the portion of the property you actually own after the mortgage is considered.
So if I have a mortgage, I'm looking at a different cash flow number than someone who owns the property outright.
That's right. Equity cash flow shows you how much money your investment is generating for you, considering the impact of those mortgage payments.
Wow, more complex than I initially thought.
It can be, but it's important to understand these different types of cash flow. They're crucial depending on your situation and your goals as an investor.
Makes sense. So we've defined what kind of cash flow we're analyzing. What's next?
Well, then you need to determine the time frame. How far into the future do we want to project our cash flow?
So 5 years, 10 years, even longer.
It depends on your goals and the property you're analyzing.
I imagine the further out you go, the less accurate those predictions become, right?
Absolutely. Market conditions change, interest rates fluctuate, unforeseen events can pop up.
So how do we choose the right time frame then?
It's a balancing act, really. You want a time frame that gives you a realistic picture, but you also don't want to go so far into the future that your projections become unreliable.
So a time frame that's meaningful, but still grounded in some semblance of reality.
Exactly. Okay, once you have your cash flow type and your time frame, we move on to the calculation.
The numbers, bring it on.
Step 3 is where we factor in the initial payment you made for the property.
So purchase price, closing costs, all the upfront stuff.
You got it. There's a detail in our source material I found interesting. Stamp duty, which is the tax you pay when you buy a property, it varies by state.
Oh, of course. Different states, different rules.
And it's progressive, too.
Progressive, does that mean the more expensive the property, the higher the tax rate?
You nailed it. It's a good reminder that local regulations can have a big impact on those overall costs.
Yeah, those hidden costs. Gotta watch out for those.
Exactly. Thorough research is key.
All right, so we factored in our initial payment. What's next?
Now we start looking at the income and expenses from actually owning and operating the property. This is step 4, where we calculate what's called equity cash flow before taxes.
So that's where we take our rental income, subtract the operating costs, the mortgage payments, property taxes, maintenance, all that.
You're getting it. But there's a twist. We also need to factor in vacancy allowances.
Vacancy allowances, what are those?
It's basically a buffer for empty units. No one can guarantee 100% occupancy all the time, right? You have to account for times when you might not be collecting rent.
Yeah, makes sense.
And get this. Our source material points out that this equity cash flow before taxes, it can actually be negative.
Negative. Wait, you can lose money even before taxes come into play.
It's called negative gearing. And it's more common than you might think, especially in the early years of owning a rental property.
Okay, color me intrigued. Tell me more about this negative gearing thing.
Well, remember all those expenses, mortgage payments, property taxes, vacancy allowances. If those costs exceed your rental income, you're in negative gearing territory.
So you're basically betting that the property's value will go up in the future enough to offset those early losses.
That's a common strategy, but it's not without risk. It requires careful planning, a solid understanding of the market.
This is why we're having this discussion, to really understand these mechanics.
That's right. Now, step 5 is where things get really interesting.
Oh boy. Is it time to face the tax man?
Yes, it is. This is where we dive into the world of tax deductions.
Everyone's favorite topic.
I know, right? But it's important. They play a huge role in that after-tax cash flow.
So are we talking about depreciation, mortgage interest deductions, all those juicy tax breaks everyone's always talking about?
You got it. But our source points out something a little counterintuitive. Capital expenditures and sinking funds, these are important, but they are not tax deductible in the same way as some other expenses.
Hold on, wait. Why not? Those are legitimate costs, aren't they?
They are, but the tax code has its own rules. Capital expenditures, like replacing a roof or upgrading a major system, are considered investments.
Investments that increase the property's value.
Exactly. They're handled differently than your regular operating expenses.
So what about those sinking funds? I thought those were meant for repairs and things like that.
They are, but they're meant for future costs, not immediate ones. So they're not deductible right away.
Ah, I see. It's all about the timing and how those expenses are categorized.
You got it. And this is why having a good tax professional on your team can be incredibly valuable. They help you navigate all these complexities.
I'm realizing just how many details are involved when it comes to real estate taxes.
And this is just the beginning. Stay tuned for part 2, where we'll take all these calculations and use them to evaluate properties, make those smart investment decisions we talked about.
I'm ready for it. Back again for more after-tax cash flow fun.
That's the spirit. We've gone through those calculations, all those expenses, vacancies.
My head's spinning a bit, but in a good way. So how do we actually use all this information about after-tax cash flow? Like when we're looking at properties, trying to make a decision.
That's the key question, right? It's not just about tracking those numbers. After-tax cash flow, it's a tool.
A tool for what?
For assessing the true value of a property.
So figuring out if a property is really worth what they're asking for it?
Exactly. And we're looking beyond just the price tag, right? We're factoring in the income potential, those tax implications, even broader market trends.
So we get a more realistic picture of the property's value.
Right. And one of the most useful tools for this is something called discounted cash flow analysis, or DCF for short.
DCF? Sounds a little intimidating.
Don't worry, it's not that bad. It's all about understanding the time value of money.
Okay, break that down for me.
Basically, $1 today is worth more than $1 tomorrow.
Makes sense.
DCF helps us account for that by discounting those future cash flows back to their present value.
So we're saying, okay, this property might bring in this much cash flow over the next 5 years, but what's that actually worth right now?
You got it. And that's where our after-tax cash flow calculations come in. We use those numbers to project the future income. Then we apply a discount rate to figure out their present value.
And I'm guessing that discount rate is pretty important.
Oh, it's crucial. It reflects the risk associated with that investment. A higher discount rate, well, that means more risk. Those future cash flows are worth less today.
So a riskier property would have a higher discount rate. Those future cash flows would be discounted more.
Exactly. Think about it this way. You're investing in a stable property, nice area, low risk. You might use a lower discount rate.
Yeah, seems reasonable.
But if it's a fixer-upper or a neighborhood that's, changing rapidly, you'd probably use a higher discount rate because there's more uncertainty.
So it's not just plugging numbers into a formula. You need a good understanding of the market, those risks.
Absolutely. Looking at comparable properties, considering interest rates, your own risk tolerance. It's a bit of an art and a science.
Like putting together a puzzle, but with numbers.
It is. And that's part of what makes real estate so interesting. Always something new to think about. So we've done our DCF analysis, factored in the risks, chosen our discount rate.
What happens next?
We get something called the net present value, or NPV. This tells us what the property is worth today, considering those future cash flows and the risks involved.
So positive NTV, that's good.
Generally, yes. It suggests those future cash flows, discounted back to today, are worth more than the initial investment.
Meaning I'm likely to make a profit.
Exactly. But a negative NPV, that's a warning sign.
Time to walk away.
Not necessarily, but it definitely needs a closer look. Could mean the property's overpriced, or those cash flow projections are too optimistic. Maybe the discount rate doesn't fully account for the risks. It's a sign to proceed carefully.
So, gotta do your homework.
Always. Valuation is a process. It takes analysis, some number crunching, and a good dose of critical thinking.
Speaking of critical thinking, our source material also mentioned analyzing cash flow patterns. What's that all about?
Right. It's about looking beyond just the numbers and thinking about the story they tell. The source outlines 5 distinct cash flow patterns.
5. Okay, tell me more about these patterns. What kind of stories are we talking about here?
Well, the first one describes a situation where you might have negative cash flow in the beginning. You need to put in some extra money to cover expenses.
Sounds a bit risky.
It can be. It's typical for properties with high growth potential, but low initial yields, like, say, a new development in an up-and-coming neighborhood.
So you're banking on future appreciation to make up for those early losses. High risk, high reward.
Exactly. This pattern might be attractive to investors who have a higher risk tolerance, a longer-term outlook.
Got it. And the other patterns?
The second one is all about capital growth. You might have very little cash flow, even negative, during the time you own the property, but you're hoping for a big increase in value when you sell. Think about a historic building that needs a lot of work.
In an area that's being revitalized.
Right. It might need a lot of upfront investment, ongoing maintenance, but the potential for appreciation could be huge.
Sounds like a strategy for someone with a long-term vision.
Absolutely. The third pattern, it offers more of a balance. You're aiming for both income and growth. The cash flow starts positive, and it increases over time.
Okay, I like the sound of that.
Think of a well-maintained rental in a stable neighborhood.
Solid, dependable.
It brings in steady income right away, and as rents go up, the property value increases, your cash flow grows too.
The best of both worlds.
It's a popular choice, a more balanced approach.
Okay, what about the last 2?
The fourth pattern is all about consistent income. Like an annuity, you get a predictable amount of cash flow each year.
Sounds good for those who like predictability.
Exactly. This could be, say, a commercial property with a long-term lease to a reliable tenant.
Steady as she goes.
Right. And the fifth pattern is a bit different. It's about a big payout at the end, when you sell, with little to no cash flow before then. This could be a property you buy for its land value, thinking you'll sell to a developer later on.
Interesting. So each of these patterns represents a different approach, different goals.
Precisely. Recognizing that not all cash flow is the same is crucial. That timing, that consistency of the cash flow, it really impacts how attractive an investment is.
We've covered a lot of ground today. My brain is definitely full.
It's all about building that understanding. Once you grasp those core concepts, you can start applying them to your own situation, make those smarter decisions.
Feeling more confident already. What else do we need to cover to really master this after-tax cash flow game?
Well, in our final segment, we'll tie it all together, give you the key takeaways, the most important things to remember so you can use this knowledge for your own real estate adventures.
Can't wait. All right, final part of our after-tax cash flow deep dive. What are the key takeaways here? What do we absolutely need to remember?
Well, I think the most important thing is this. After-tax cash flow, that's the real measure of your investment success.
It's the bottom line.
Exactly. And like we talked about, calculating that number, it's not a simple formula. 8 steps, each one giving us more information.
We talked about those steps, yeah. Defining our cash flows, picking the right time frame, factoring in those initial costs.
And don't forget about those tax deductions. A lot to consider there.
I'm telling you, I've learned so much about real estate taxes just from this conversation. There's so many details.
There are. And those little details matter. Vacancy allowances, those rules about capital expenditures, they all affect your cash flow.
Yeah, I'm starting to see the bigger picture now. And those cash flow patterns, that was a big one for me. Negative gearing, lump sum payouts. It's amazing how that timing and consistency of cash flow can really change your whole strategy.
Right. not all cash flow is created equal. Some investors are fine with negative cash flow at first if they think the property will grow in value later on.
Others might want that steady income right from the start.
It's all about finding the right fit for you.
So for our listeners out there ready to jump into real estate, what advice would you give them?
Don't be afraid to dive into those calculations. Get familiar with those 8 steps, try different scenarios, get comfortable using those tools.
Get those spreadsheets fired up.
Exactly, and never stop learning. Stay curious. The real estate world is always changing. You got to keep up with the trends, those tax regulations.
Always something new to learn.
And don't be afraid to ask for help. Talk to experienced investors, tax professionals, financial advisors. They can give you guidance, a fresh perspective.
You found yourself with a good team.
Exactly. Real estate investing, it's a journey.
Yeah.
Take your time, do your research, make smart choices that work for your goals.
Well said. Well, we've reached the end of our deep dive into after-tax cash flow. We've broken down those calculations, looked at valuation, explored those cash flow patterns.
Hopefully everyone listening feels a little more confident now, ready to tackle those real estate challenges.
I know I do. Time to put all this knowledge into action. Thanks for joining us on the deep dive, everyone.
Happy investing.
Until next time, keep learning, keep exploring.